Okay, welcome to our investment presentation for the Market Weatherford. Beautiful brand new property, Class A. Just to give you a little backstory, this property is owned and built by the same developer, and they've got numerous properties all over the place. And they build for long-term ownership. And so they build quality construction, long-term hold ideas, not somebody who's just throwing something up to get a product up there to sell. Their intent was to hold on to the property. However, they've got other properties that they're currently building, and so they decided they'd sell a couple of the assets because of the debt crisis we're in right now. And so we are lucky enough to have this one under contract. Let me show you a little bit about it first. Beautiful construction, 4 stories, 10-foot ceilings, beautiful. If you want to stop, you can read all this other information, which is absolutely nothing. There's a good property picture. Fire pit, nice big pool, 3.5 feet deep. So it's more of a hangout pool, a nice big club, outdoor grill and TV and sitting area. And they've got these little notches in for sitting areas, if you can see any of those. Again, the 355 units, brand new in Weatherford, Texas. Pretty pictures. That's just an exterior shot of one of the sitting areas outside. The middle is the clubhouse, right in the middle of you come into the right and come into this whole area. And actually, you can see it here. We're coming in the front door here. And on the right is the leasing desk, and on the left is decorations. And 2-story high entryway going into the clubhouse. Here's an overview of the property. Again, all big, beautiful 4-story, 10-foot ceilings. Right across the street is Weatherford College, the only college out in Weatherford. This is brand new, flat roofs, HVAC systems on the roof. And they did something really unique. Right in the middle, you can see a retention pond. They put in a water well that fills up the retention pond, and the retention pond now is what's used to water all of the grass. So that's real nice. That'll save about $18,000 a year off of our current water expense, or their current water expense, because that was just completed. We also have this big green belt area down here. They had it set up for a soccer field, and we are actually looking at putting it in possibly a couple of pickleball courts or some amenity that clientele would like to see. Here's some more pictures of the property. They've got a game room, pool table, a card table, TV, games, everything like that. Top right is a sample interior. Bottom left is a sample bedroom. And then bottom right is one of the common areas where they've got cornhole, and you can just see it's all just beautiful. It's just a gorgeous property. It's located in Weatherford, Texas, which is 25 miles west of Fort Worth, right out I-20. I-20 and I-30 come out of Fort Worth. They merge together into I-20 and come out to Weatherford. Now, the mark is located right here. You can see where it's located, right in the center of town right here. And right around it is all of the major new construction. This 171 going north-south is the major thoroughfare. That's Main Street going right up through center town. The east-west 180 is an older road where you can see there's Brookshire's, Family Dollar, things like that. That's an older road. All of the new development is down here by the freeway where the mark is. Walmart, Home Depot, Office Depot, Starbucks, Cane's, Panda Express, all of that in that area. Then Target, Lowe's, Chick-fil-A, Kohl's, Whataburger, Best Buy, Ross, JCPenney, Bed Bath & Beyond, everything is right here. So it's a major growth area just outside of Fort Worth. Weatherford, 950,000 jobs within 25-mile drive. Well, that includes Fort Worth. Average home price, $380,000 out in Weatherford, and 12% increase over last year. But that is a pretty high average home price for that area, and a pretty decent average household income of $68,000. Population growth, $30,000 more. It's doubled over the last 10 years. It's got our major employers. entertainment drivers. They've got some fun things. Weatherford Movies in the park. They've got a big park area that they developed with outdoor entertainment, movies, etc. They've got a food park out there that you can go to. And one of the things they're known for is their peach festival. They've got a big peach festival every year. These are some pictures from that festival, which is nice to go out there. And if you like peaches and peach ice cream, it's a really fun thing to go out to. But a good event out, kind of small town feel in Weatherford, even though it's right near Dallas and Fort Worth, mainly Fort Worth. Here's the property right in the center, and this is looking south. So on the bottom part of your screen is Weatherford College, and then the gray, the amber looking color on the left, JCPenney McAllister's. You can see all of the developments right around the property, and with the college, great location. It is not a college property, yet we do have students and faculty that live there. Another view now looking north, so you can see Weatherford College, Weatherford ISD, Big Lots, etc. All of that here in this great overview shot. So then this is another beautiful shot of the property. That's the, right in the middle is the hangout area for the pool. Now we've got a putting green in this area with artificial turf. It's a view of the clubhouse. Again, overlooking the pool in the back, and to the left side coming in is where the front entrance is. We are going to have to change the name of the Market Weatherford because that's their brand that they do, this developer does, and because they're no longer going to own it, they don't want to allow us to use that name. So that's the one major CapEx that we're going to have, which is changing all the signage. Built in 2021, 302,000 square feet, concrete slab, individual water, individual electric, individual HVAC, all of the good stuff for a brand new property. Again, there's the top picture is the office. You can see office, private office in the back, but then leasing here in this curved granite and rock desktop area. The front entrance, and again, more pictures of the property. So here is again the pool area of the Mark. Beautiful, right in behind those glass door, those windows there is where the office is. Here's the interior of the units, granite countertops, private yards on the first floor, stainless steel appliances, granite countertops, nice backsplashes, vinyl plank floor, a nice big tub, and washer dryer connections, private balconies, built-in work and study desk, under cabinet lighting, 10-foot ceilings, and garden tubs or walk-in showers, depending on where they are. And even the faucets are nice. I mean, everything they put in here was quality. In top left, kitchen, dining room area. Top right, you've got the living room along with the dining area. You've got the master bedroom along with the master bath here, and you can notice the nice designer tile around the tub with the dual sinks. Again, just a beautiful property, big walk-in closets. Another picture of the interiors they've got islands, which is a nice little added feature. 10-foot ceilings really highlighted here with the windows above the door and the living room. Again, this is the clubhouse. You can see, okay, bottom right-hand corner, that is, as far as a table, right behind it on the right, you can't see, is the kitchen countertop in the clubhouse. All the sitting areas in the glass behind this community amenities box there's a game room, the office in the front, catwalk up above with a 2-story fitness center. You've got business center, people can come sit down here, bring their laptops, use the printer, work in this area. And then they also have 2 private conference rooms or study rooms, whatever you want to use it as, that you can rent out. And here is the game room. Again, beautiful, gorgeous property with all the amenities. 2-story fitness room. So you've got a downstairs fitness area. Upstairs has the ellipticals and the treadmills, etc. Then also you can see there's a door that goes into a fitness room, aerobics, Pilates, whatever you want to do in there. Again, more beautiful pictures. And this bottom right is the covered area right outside the pool. So you've got TV, fireplace, sitting areas, grills, a real heavy amenity rich property. You've also got your gazebos out here. I'm sorry, the cabanas out here that you can go ahead and utilize also. They think of everything on this property. Floor plans, even though it says studio, it's just a small 1-bedroom. So there's a separate bedroom, not really a studio. I'd call that a small 1-bedroom, but they do that. All the different floor plans, all the way up into a 3-bedroom, 2-bath unit, 1,151 square feet. So very big units. Here's the site plan. They've got it designed for a soccer field here. And I think that, like I said, maybe we'll put in 2 of the pickleball courts, might be better for that demographic, and at least be able to add another amenity. You can see parking's all the way around the outside, 1 entrance, and all of the amenities are really inside of the big courtyard area, which also gives a great view of everything on the inside. Show you some more pictures real quick. Again, beautiful resort style pool. I love when other properties say they have resort style pools and nobody has it like this, with a fire pit and the seating area in the pool, etc. Another view. And then it goes into, you know, why DFW is great, fastest growing, more pictures, and then market comps, where those comps are located. If you look at those, they're all on the outside of town. They're not near anything. And this one that's number 2, that's a new property, but it is very low quality, especially in comparison to ours. And it's not very pretty. You'd like to see that, I'm sure. But rental rates, more pictures, their investment summary on what they think it's going to do. Oh, but they're saying, by the way, add washers and more washers and dryers. They already have 64 of them in there that they charge an extra $50 a month. Well, this is an extra $213,000 in potential revenue, and it costs $1,000 a unit. I don't think we're going to do that because we can get a revenue participation without owning washer dryers, by the way. I don't like owning them because there's a liability to them. If something happens and it floods a unit, it's our responsibility. Whereas if we have a third-party leasing company, we can still get revenue share without spending the $291,000 to go ahead and put those in. Their numbers, 10-year cash flow, unit mix, which we'll have all that on our analysis. But again, I'll go back up to the front, up to the top, just to show you again, one more picture of the property. Okay, now I want to show you our analysis. Okay, now going through the numbers. Those of you who want the detail on how this works, most people don't go through all the details like I do, which is nice that we get to go through all those numbers with you so you understand how it all works. We're paying $76,750,000, $216,000 a door. Let me put that into context. Back in January, they had no interest in selling the property, and they were getting offers at $315,000 per unit. Again, in January, they were offered $315,000 per unit. With the debt situation and for them to be able to sell it now, we've got it under contract at $216,000 a unit, almost a third off. So a huge, beautiful property on sale, almost 30% off. We've got closing costs that are budgeted in there, capital improvements of $300,000, operating account, put $500,000 in that, $80,000 in potential miscellaneous. We're looking at a loan that's going to be between $48 and $52 million. That changes on a daily basis based on the prevailing interest rate. We'll talk about that in a few minutes. So that could be higher or lower. And pref equity of $10 million. Now, if we go ahead and raise, if we don't have the pref equity, then we're going to have to raise more money and our returns go down. Give you an idea, if we don't have the pref equity, the returns average right here, 12.5% per year, but with the pref equity, 17% per year. What if we can get the $52 million loan? Then our returns go to 19.9. which could also give less on a pref equity. So all those numbers get moved around depending on what we want to do and how the final loan numbers come out. Okay. DGRE is the sponsor. We retain 20% ownership. There is a 1% acquisition fee involved in that as well. Looking at a $49 million loan. I've got 5.65% interest rate in here. We are looking at a Fannie Mae 10-year loan, 10 years interest only, fixed at 5.65. Now, as of last week, we could have gotten 5.2% interest. And just give you an idea, 5.2, that bumps up the return about half a percent. So I'm budgeting 5.5% interest rate right now. However, because we don't want to get hit with these heavy defeasance or prepayment penalties if interest rates go down, so we're actually going to pay 15 bips higher than the 5.5, so 5.65% interest rate. And what that does, that gives us 3 years. After 3 years, we don't really have a prepayment penalty, which saves us a whole lot of money. And that's the whole reason why I would want to do an adjustable rate loan. Let's talk about that real quick. An adjustable rate loan, there's a spread. There's the index, and then there's the spread. The index being SOFR, which is one of the major indexes, or 10-year treasuries or 2-year treasuries, whatever it is. With Fannie Mae on the 10-year, on the fixed rate loans, they use the 10-year treasuries. Well, there's an inverted yield curve. 10-year treasuries right now are actually at a lower rate than the 2-year treasuries. The 2-year treasuries would have a similar spread on them, but the current rate is higher on the 2-year treasuries, making adjustable rate loans more expensive than the fixed rate loans right now. And then you also have to buy a interest rate cap, which is going to cost a heck of a lot of money to go ahead and buy. So I'm always a fan of fixed rate debt on all the properties. And that's why we're not in trouble on any of our assets right now, is because we had fixed rate debt on most all the properties, and then we switched those over to fixed rate on the 3 that we did not have fixed rate loans. And that was just because they were bridge loans. So again, we try to minimize risk rather than maximizing profit. Adjustable rate mortgage, in the past, you could get a little bit lower rate, but then you got stuck if something happened, and there's going to be a lot of damage to people here in the next year because of those adjustable rate loans. Now, we put in a supplemental loan. This is our year 3 refinance. So all I did was say, okay, it's going to be $64 million loan. So it's going to be a difference between the current loan and the new loan. See, when we look at a refinance, I call it a refinance, but it could be a supplemental, meaning that a refinance, you get a whole new loan that pays off the entire loan with a new loan. A supplemental is like a second loan, so that we can go ahead and take out that second. So let's just say that interest rates drop in 3 years, and let's just say they're 4%, okay? I can take in my analysis here and say 4%, and now look at how much the overall return changed, 19.5 as opposed to 17%. So 2.5% bump just because of a lower interest rate. It would also give more cash out, etc. However, we need to remain conservative, so we did 5.75. Unit mix. This is our current unit types. E's are efficiency. Ours is really a 1-bedroom. A's are 1 bedrooms. B's are 2 bedrooms, and C's are 3 bedrooms. 355 units. Average square footage is 853 square feet. Current effective rents for the leases they've signed over the last 3 months. This is their effective rent. We went through the rent roll and looked at every lease that was signed since September, and these are the average rental rates for those leases. So it's $1,586 average rent. which gives per square foot total and total rent. Now our pro forma, we say, what can we do? Well, all we did was we bumped this up about $60 over their current rent, which is only a 4.2% increase over the previous year's rent. So we're looking at a 4.2% rent increase this year. With high inflation, we think this will probably be higher, but I want to be conservative. Again, 355 units built in 2021, 11.5 acres, and just stats on that. Our improvement budget, $60,000 for signage, $50,000 for pickleball courts, leaves us $190,000 in additional cushion for whatever we might want. Okay, so again, effective rent, $1,586 average. We're only taking it to a $1,653 average. Okay, so not a real high bump. Okay, so now we take this out. Their current effective 563 times 12 is their current effective their current market rent, $6,756,000 based on their effective market rent. Their actual collections, $5,006,000, which gives us a 16% vacancy and collection loss. Again, a lot of that is because of a lease up and doing concessions that we'll have to burn off. Other income, $786,000, giving us a collections of $6,004,000. Total expenses, $2,650,000, and current net operating income, $3,776,000. That's giving us a current cap rate of 4.9 or tax adjusted at 4.4. Now I do 3 different sets of numbers. I do minimum, meaning if I screw up, this is what it's going to be. If I do really good, this is what it'll be. However, we put it in the middle of where we think it's really going to end up and come up with 10% vacancy and collection loss. We think we're going to be raising the income a little over 10% overall the first year. Our expenses, we're going to take from $2,650,000 to $3,072,000. The biggest jump on that always is property taxes. And even though year one I'm budgeting $1,350,000, because we're not closing for another few months, I think that that's going to be much lower in year one, but then it'll bump up to $1,350,000 and then go up every year thereafter. Another big bump is insurance. Their current insurance is $151,000. I'm budgeting $750,000 per unit as insurance, which is extremely high, and insurance rates are getting absolutely crazy. Gives us our net income. So our debt coverage ratio based on that is 1.47, great debt coverage ratio. Cap rate of 5.3 on projected numbers. Cash on cash year one, 4.8 on a property level. And this is with our company expenses, which is asset management fee, taxes, accounting, etc. Reserves, $250 per unit. That just goes into a savings account. And our debt service, which we already talked about a minute ago. So we take this whole column and transfer it over to our 5-year projections. So that sponsor performance is our year one. Now we go ahead and project out from there. Income increase 5.5, 5, 4.5, and 4. And that's mainly because of inflation. Expense increases 3%, 2.5, 2, and 2. We plug in collection loss of 1. And we also, which is right here, that's the collection loss. We also have vacancy at 7%. So we're looking at an 8% vacancy and collection loss. Other income goes up just like income does. Our expenses go up just like the expense increase going right on down. Now, I want to point this out. I added in years 1 and 2 an extra cushion of $300,000 year one, $150,000 in year 2. And that's just additional cushion. And that's just in case we're off on our collections are a little bit low, or expenses are a little bit low. It's just extra, just in case money there. We go out year 3 and we say, okay, year 3, we want to pay off that private equity. So we're either going to do a refinance or supplemental. And in year 3, we're saying the value is $106 million. Let me show you this back here. We are all in at $80 million, and we put $21 million in cash into it. Okay, we're all in at 80 with $20 million in cash. Year 3, it's worth 106 million. And that is actually pretty low. That's about $300,000 per unit, which is lower than their offer they had back in January. We look at taking 60% of that cash out. That could be as high as 70%. And just for grins, if that were 70%, then we're talking about a cash out refinance in year 3 for the partners of 50%, 49.67% to be exact, as far as a projected cash out refi if we can hit 70%. Right now we're budgeting 60% to be conservative, which is only a 10% cash out. Again, be conservative. Pay off our existing loan, or if it's supplemental, that's going to be the base. So we have enough money to pay off our pref equity so that they're out of the picture altogether and have proceeds left over to go to the partners. Year 4, we operate. You notice that the loan amount went up because the debt service went up because the loan amount went up. And then just so that we have a budgeted exit of 5 years. Again, that could be 3 years, that could be 10 years. We just budgeted in 5 years so we can come up with an exit and what the total returns would be. And again, we're saying the value didn't go up very much from 106 to 107, those extra 2 years. But again, that's still, actually, I'll tell you real quick, that is $302,000 per unit, which is still $13,000 lower than what they were offered back in January. Cost of sale, loan payoff, and we have proceeds. So we take these numbers here, mainly the cash flow, net operating income, and say, how is that going to work with private equity? So this is the same numbers from right down here. I like to go here, say, 1,391,000, that's our net income, our cash flow, I should say, and proceeds from the sale, 41 million. So this is the property level of what the property will do. So year 1, our cash flow is 747. The amount of pref equity that we owe is 1.3 million. Okay. We have a current pay. We only have to pay 600,000. Okay, so they accrue 13%. It compounds and accrues, but we paid 6%. So, which is what we paid, is 600,000. So our pref, which was $10 million, goes up by $700,000 because we didn't pay the full 1.3. No payoff of the pref balance 10 million, cash flow then is 147. 147 comes down to property level. And then what we put here is something that everybody likes, is what do I get? If I put 100 grand in here, what do I get? And year 1, only 0.5%. And I also do that to manage expectations. You remember, I've got $300,000 in here in cushion. Well, which is another 200% on top of the cash flow right here. So that could be higher, but again, I wanted it in cushion just to manage expectations. Year 2, 2.5%. Year 3, you've got almost 4% plus 10% of cash back. Year 4, you get 4.2. Then year 5, you're getting 163 back. After your return of capital, that's a 17% per year average annual return. Again, 17% per year average annual return over 5 years. And that is being very conservative on all of the numbers. Like I said, here, let me show you this one. What if the cap rates come back down to 4.5? Now you're at a 25% return. Just that one cap rate changed it to 25%, okay? And we can go through and play with the numbers all day long and show what it is. Our pref equity might be at 12%. So all that does is barely move the needle, but an extra 0.3% based on that, okay? So that's how all the numbers pan out. If somebody invests, for example, $500,000, they get 1.84% ownership. The sample is a $100,000 investor that only gets 0.37%. Okay, so you can invest any amount you want into the deal. We're going to be accredited investors only. If you have any questions on that, reach out to the investor relations team. And again, here's our purchase information, how much it is per unit. The year 5 value, 107 million, which is only $300,000 per unit, okay? I'm gonna go back and do this again. If this were 4.5%, then we're talking $335,000 per unit, which is only a little bit above what it was a year ago. So, and it would provide a 26% return. Again, we go into these deals shooting for a 16% return, which we're at 17% on this. The majority of the time we beat our projections pretty dramatically. And that's what we're hoping to do here. However, like I said, I'd rather remain conservative and do this. So if you're interested in making 17% per year average annual return, then this is the deal that you want to be in. And again, Class A, beautiful, gorgeous property. So again, we'd love to have you involved. Reach out to our investor relations team and they can get you hooked up. And again, it'll be accredited only, minimum of $100,000 investment. And this will be a great deal, something very, very proud. You can be very, very proud to own. Very big pride of ownership property, gorgeous quality construction. So love to have you involved. And thank you so much for going through this whole webinar. And if you have any other questions, please reach out to investor relations team and they can help you out. Thank you so much. Goodbye.